I got lucky in terms of timing. The book came out one day, the next day Meta, and a few weeks later Booking.com and software, CRM, and now Google. It's coming for the tech space. It's time. The interest rates have stopped going down. Buybacks are controversial. NASDAQ has matured. The environment has changed. The 40-year environment has changed. These companies are going to start paying dividends, and those that can't are going to have problems.
Within all your research, and folks, again, I can't say enough what a grown-up book this is. Is it about the dividend, or is it about the dividend growth?
The market space for the past couple decades, really the last 2 decades, has really been about dividend growth because yields themselves have been very, very low. And so that's where you get this aristocrat concept, which is a very nice marketing concept, doesn't have any standing in academic finance or as a practical matter, but it sounds really, really good. And it's characteristic of the last couple decades when yields were low, but you could grow the dividend high off of a very low base. If you do the math, however, and some people do the math and others don't. The upfront yield's also very, very important, particularly in we had decades of declining interest rates and long duration looked really, really good. In a shorter duration environment, I'll use duration in terms of equities, you want to have an upfront payment. So it's a combination of both. It's dividend yield and dividend growth. I will tell you, as what I refer to as a dividend investor in a stock market, having a fairly high yield makes dividend growth harder. Having a lower yield makes dividend growth easier. Try to do both and have a good balance.
Hey, Dan, I'm looking at some of these dividends that we are seeing from the tech companies, and I'll throw Apple in there, which has a dividend yield of less than 1%. Are these token dividends from your perspective, just so they can get into your portfolios and other dividend-focused portfolios? Or do you get a sense that Silicon Valley has fundamentally changed and say, hey, dividends are a viable place to deploy my free cash flow in addition to buybacks?
I think it's more token at present. So there are many funds, structures, indexes, and so forth that require a nominal payment to be included. And you see that. But if anyone's a serious income-oriented investor or doing the DCFs or DDMs, a yield of 1% or a 0.5% just doesn't cut it. Now, someone will point out that if the yield on cost for, say, a company like Microsoft or Apple from decades ago is outstanding, and they're completely correct. They're absolutely. But you've had to endure decades of very low yields until your yield on cost caught up. So for now, these are nice, symbolic, important moves. I refer to it as the return of the cash nexus, but real dividend investors aren't there quite yet.
Dan Peris with us. I can't say enough about the ownership dividend. Really, really good. Thin, but really adult, really thick. Requires some work to get through it. It's a pro book on dividends. Dan Peris, you have the joy of meetings with Steve Authland-Dussel and others. And I want to talk here about Michael Mauboussin's work. This is 20 years ago, Mauboussin saying praying at the altar of the terminal value is not all that valuable, and that what really matters is the year-by-year deployment of free cash flow towards a constructive use of capital. Describe how the year-to-year is more important than some CFA mumbo-jumbo about the terminal value.
Yeah, I heard you make that point about an hour ago, and I smiled as I was driving in. Yes, because you can make the terminal, if you torture the terminal value enough, you can make it confess to.
You can say anything. Sweeney, you've done that.
I've done that once or twice.
And the beauty of a terminal value is that the torture only needs to be very subtle, and you can get it to change dramatically. I use a much simpler heuristic, and it looks out over the current dividend yield and the current dividend growth over the next 5 years. That involves 1 or 2 basic assumptions, but I think it's less subject to abuse than a terminal value. But basically, it's an internal rate of return, what the current yield is plus the forecast dividend growth over the next 5 years. Now, you can be wrong over the next 5 years, but at least you're not engaging in the artistry of a terminal value.